Welcome, everyone. Let's dive right into this explainer and cut through the daily headlines, all right? We are going to uncover the real macroeconomic drivers that are pushing gold and silver into this massive new bull market. Right now, there is just so much chatter out there trying to figure out why these metals are moving the way they are. But if we really want to understand the trajectory of our wealth, we have to look past the obvious and start looking at the structural shifts happening right beneath the surface. Now, what's really fascinating here is the stark contrast between the chaotic, surface-level distractions the media feeds us and the massive, hidden reality occurring right behind the curtain. While everyone is completely fixated on, daily oil fluctuations or whatever geopolitical noise is dominating the news today, central bank buying records are quietly being absolutely smashed. It's so easy to get swept up in the panic of the 24-hour news cycle, and because of that, most people have really lost sight of the bigger picture. If you think the top is already in for precious metals, well, you need to peel back the layers. We need to look at what the biggest, most powerful players in the world, the central banks, are actually doing with their massive piles of cash. They aren't day trading the news, they're making generation-defining moves. All right, let's jump into Section 1, the record-breaking bank buy, focusing on that fresh Q1 2026 data. So the crucial point here is exactly how you measure this buying. Mainstream financial news wants you to focus strictly on a decrease in physical weight, like fewer tons of gold. But doing that completely ignores the true magnitude of what's happening. Because when you measure it by actual US dollars spent, the amount is hitting a staggering all-time record high. $37 billion. Let that sink in for a second. In just the first 3 months of 2026, central banks collectively dropped over $37 billion on gold. They are absolutely not backing away from the table. By continuing to allocate this mind-blowing magnitude of capital into precious metals, they're setting a brand new, undeniable record for value. To put that into perspective, remember the massive buying spree right after the US froze Russian assets back in 2022? That was a huge wake-up call for the world. Well, get this. That $37 billion is a massive 55% increase over that 2022 panic buy. The big players are spending more than ever before, and it signals a total undeniable loss of faith in the US dollar as a safe reserve asset. Moving on to Section 2, real interest rates explained, also known as the Fed factor. Now let's address the elephant in the room. The market has pretty much already priced in the idea that the Fed will hold steady. Let's say they keep it at a 3.7% interest rate, meaning no more rate cuts for 2026. But that nominal 3.7% number, it doesn't tell the whole story. Actually, on its own, it's virtually meaningless to large institutional money. To really understand what happens to capital, we have to look at real interest rates, which is simply the nominal interest rate minus the rate of inflation. This equation right here is the actual metric that cash savers, sovereign wealth funds, and those massive institutional investors actually care about. It dictates if your money is actually growing or if it's silently bleeding out. Let's walk through the math real quick. Step 1, you take that nominal Fed rate of 3.7%. Step 2, subtract our current incredibly sticky inflation. And Step 3 reveals the truth. You're left with a tiny 0.4% real yield. And honestly, unofficially, if you factor in the real cost of living, that rate is likely already negative. Basically, your cash is losing value simply by sitting still in the bank. And this dynamic creates what we call a structural inevitability. See, when cash savers realize they're actively losing purchasing power despite these quote-unquote high interest rates, their flight to gold and silver isn't just a speculative trade anymore. It's a structural necessity. Capital is literally forced directly into hard assets just to preserve wealth. So even if the Fed holds steady, rates are effectively decreasing in real terms. All right, let's look at Section 3, the blueprint and long-term targets. Remember back at the end of 2024? Pundits were terrified. They were pointing at charts, screaming about bear flags, and predicting gold was going to plummet to $2,000 an ounce. But while they were panicking, the actual outcome was entirely different. Central banks stepped right in and bought nearly 12 million ounces in a single quarter, providing an absolutely rock-solid price floor. The drop never happened, simply because the biggest whales in the ocean wouldn't let it. And because these big players are constantly providing this floor, the data points to a very clear timeline for us. We're looking at a major momentum shift upward in less than 8 to 12 weeks. And because of the immense capital flowing from these central banks, you got to understand this isn't some temporary blip. This is an irreversible trend. So, the huge takeaway here is that the long-term targets set by the structural shift remain completely intact. Driven by the massive institutional volume we've just been talking about, the math points to gold aggressively pushing above $7,000 an ounce, and silver hitting somewhere between $150 and $200. I mean, the trajectory is incredibly clear when you just follow the volume. The ultimate takeaway from all this data: ignore the noise and follow the money. Seriously, turn off the chaotic daily headlines about whatever geopolitical crisis is trending today and trust the hard math. Follow exactly what the central banks are doing with their billions, because they are telling you loud and clear exactly where the market is going. I'm going to leave you with this provocative thought to ponder. With all this massive, record-breaking capital moving into hard assets to escape negative real yields, do you think the Fed will be forced to cut rates sooner than the market currently expects? And if they do, throwing even more fuel onto this raging fire, what are the implications for your own portfolio? Thanks for joining me to unpack the data today, and I'll see you in the next explainer.